it might look like M&A mania, but our next guest says it won't last. Fred Lane is Vice Chairman of Investment Banking at Raymond James, and he joins us now from Boston this morning. Fred, good to have you with us. And, it does look like we've seen so much M&A activity because we haven't seen hardly any over the last several years. But you say it's nothing to get excited over?
Well, listen, I think it's a positive thing, and I think it makes sense in this environment that the M&A activity has been dominated by strategic acquirers. One thing it's hasn't really been commented upon is the fact that in 2007, as an example, close to 80% of the M&A transactions completed were done on an all-cash basis. And in 2009, and so far in 2010, close to about 40%. Only 40% have been all cash. There's been a stock component. So I think we're in an environment where risk minimization is the name of the game. So these strategic acquisitions are driven by industrial logic. They obviously fill both an earnings gap and, more importantly, a revenue gap on the part of the acquirers. And the biggest and best acquirers are driving this activity. Schlumberger, Walgreen, these are leaders in their field, and they're taking advantage of this kind of environment to basically essentially minimize risk for the seller by giving them stock, in a sense, basically saying, hey, the combined entity is more valuable. I'm paying you a premium. How about going along with this? And I think it's really kind of a win-win for the sellers and the buyers in these cases.
But explain to me, what does that exactly mean? Strategic acquisitions or strategic acquirers, and how does that differ from a few years ago? Because I would presume that all acquisitions are for strategic reasons, right? I mean, what is it that's different this time around than it was a few years ago?
Well, I think private equity firms, hedge funds, and even conglomerates had the ability to borrow money at such low rates that they could compete effectively against a strategic acquirer, meaning someone who understands the business, is in the business, maybe has ability to distribute product more broadly, has ability to design product. There may be cost savings, there may be marketing and distribution advantages. That's what I mean by a strategic advantage. Right,
versus somebody who wants to come in and just break it up, or, yeah.
Well, not even break it up. Usually there's an underlying investment thesis, there's a growth thesis, or there's a cost savings thesis. That kind of acquirer is generally trying to take advantage of a dislocation in terms of people's understanding of values. Or, alternatively, and I think we saw a lot of this in 2005, 2006, 2007, a lot of these deals were being completed by people who had the financial engineering capability and the access to capital that enabled them to essentially, quote-unquote, overpay for a good business. And basically hopefully lever their returns. Now, of course, we've seen the ugly dark side of this with all of these restructurings and bankruptcies that I think will continue if the economy doesn't improve, and I think the outlook for that isn't very strong.